Hello, my name is Tim Johnson. Over the years I've prepared many tax returns for Americans resident in the UK, and I've identified 5 key problems that seem to reoccur over and over again, key traps that catch the unwary, that often with a little bit of knowledge and planning ahead of time could have been avoided. The first of those is filing. It seems obvious, but if you're an American, then almost uniquely in the world, you need to file a tax return based on your worldwide income, wherever you happen to live in the world. So, for example, even if you've been living in the UK for many years, you still are likely to need to file a US tax return declaring your worldwide income. Now, the US filing limits are quite low. For example, a single person earning more than $9,750 in 2012 would have needed to file the US tax return. And you may very well need to file a US tax return even though you don't need to file a UK tax return. And in fact, given the filing limits, most adult Americans, in my experience, resident in the UK, are going to need to file a US tax return. It's not just about a tax return. The other most common filing requirement is the Foreign Bank Account Report, or FBAR. Basically, if you have over $10,000 in overseas financial accounts at any point during the year, you need to complete one of these FBAR forms and submit it to the US Treasury. And there can be quite significant penalties that could be applied for a failure to file one of these returns, even if in fact you didn't owe any US tax. The next one that I want to talk about is to do with so-called passive foreign investment companies. US Congress enacted some legislation that deliberately tries to discourage Americans from owning non-US mutual fund type investments. These are also known as PFICs. Now, a PFIC really is any sort of non-US collective investment vehicle. For example, things like mutual funds, unit trusts, investment trusts, anything similar to that will be classified as a PFIC. What this means is that there's a complex and onerous reporting regime that needs to be complied with each of these funds, which is going to increase the work and complexity involved in completing your US tax return, but also any gains, dividends, any capital gains that you get are potentially taxed quite harshly under this regime. The next one I wanted to talk about is the sale of your home, your main residence. In the UK, if you sell your principal private residence, it's very unlikely that you're going to have any UK capital gains tax to pay. However, you could end up with a US tax bill. Why is this? Well, there are 2 reasons for that. The first one is that in the US, rather than granting a complete exemption on the sale of your main residence, the US caps it so that any gain over $250,000 for a single person or $500,000 for a married person is going to be subject to capital gains tax. The next issue is exchange gains. If the dollar has depreciated significantly since you purchased the property, you could find out that your gain when calculated in US dollars is much bigger than the UK gain converted into dollars. So you could end up, even if you don't have much of a UK gain, you might still end up with a taxable gain in the United States. The fourth issue I wanted to talk about is the repayment of a loan, typically a mortgage. If the dollar has strengthened significantly in the period between when you've taken out a loan and when you repay it, you could end up with taxable income from the IRS's perspective. So what happens here is that you need to calculate the amount that you borrowed in sterling and convert that back into dollars using the exchange rate that applied on the date when you borrowed it. Then you need to take the amount that you repay in sterling, convert that back into dollars using the exchange rate that applies on the day when you repaid the loan or mortgage. And if the amount that you've repaid in dollars is less than the amount that you originally borrowed, then that's going to be taxable income for US tax purposes. And so even though from a UK perspective there's no tax charge, in the US you could find that there is a US tax bill that arises on that. The fifth issue that I wanted to talk about is a limited company. Now, many people who set up their own business will be advised by a UK accountant to set up their own company. And in most cases, this is very sensible advice from a UK perspective. However, it doesn't necessarily catch all of the US implications of doing that. The first of those is that if you're an American and you own more than 10% of a foreign corporation, you've got additional filing requirements that you need to meet as part of your annual income tax filing. This is going to add work and complexity to meeting those filing requirements. And on top of that, even if you don't owe any tax, failure to file some of these returns could result in a $10,000 penalty for each return that you fail to file. And it's not just the filing requirement, but there could be a tax liability that goes along with that, particularly if things haven't been properly set up and planned ahead of time. You could find that you end up with a US tax, additional US tax on the dividends that you receive from the company on top of what you've had in the UK. Often with a bit of planning and so on ahead of time, you can avoid falling into this problem, but after the event it's probably going to be too late to do very much about it. Thank you.